assets. Uh, then we discussed this example also with you, equity method example, and we discussed this example in the investors books and in the consolidation financial statement. I think you can remember this example. We always take the share of investor to the books of investor, and also when preparing the consolidated financial statements. Going back again to this applying the goodwill also, we discussed this one also, applying the goodwill. This example, I think I remember how to calculate the goodwill. Goodwill is basically the difference between, you know, purchase consideration and the net assets acquired. Now, for example, here the net assets, you can remember here 100, 50, 20, that is given as at this particular date. But in addition to that, there are two stories given. One is this 10,000, and other one is this 5,000. So thereby what we can do is the revaluation. We are brought in the revaluation, but net of tax. So this is the net assets at fair value. Net assets at fair value. So you take 25% of that, and this is the net assets at fair value, your portion, and this is the purchase consideration, that is the investment. So the difference between these two is called goodwill. In addition to that, we discussed the negative side of side also. I think I remember the negative side. We call it excess purchase bargaining option. Here it is, if it is 180, you see here you get 25%, but cost of investment has reduced in this example as 45,000. So thereby you will see the purchase consideration is lower than the net assets of net assets where the investor in terms of fair value. So thereby 125 we directly charge to the, you know, P&L of the investor. That is here this 25. I think you can remember that part. Then what we'll do is today we will discuss applying the equity method across multiple years. We are discussing multiple years. Now, straightforward, we will go to the example so you can understand the meaning of multiple years then. 1st July 2013, Pico Limited acquired 40% of shares of Organ Limited, 422,400, which is the purchase consideration. Now, this is the purchase consideration, and this is the date of acquisition, DOA, date of acquisition, and you are acquiring 40%. At that acquisition date, you will see share capital is 200 and retained earning is 80,000 altogether. Net assets as per the book is 280. Then again further information, 1st July 2013, that is the acquisition date of acquisition. There are identifiable assets and liabilities which are really not recorded at fair value. So thereby we need to brought in the fair value into the books instead of this carrying value. Instead of this, we have to bring this, and instead of this 60,000, we have to bring this 70,000. So thereby what you will see, we are trying to increase the assets. Here we are trying to increase the assets by 20,000. Here we are trying to increase by assets 10,000. So that is the story. Now what happened is, since these are book values, the equity as at acquisition date in terms of book value. So what we have to do is we need to increase this net assets by this, the difference, that is 20,000 and 10,000, 30,000. But if there is any tax, we have to take 1 minus 30%, that is net of tax. This is tax rate is 30%. And I think you can remember what, you can understand what I'm telling. I'm just explaining you the scenario. And also you can see 30th June 2014, that is the year end of the first year, because our acquisition date is 13 July first, beginning of the year. Now June 2014 is the end of the year. The inventory on hand 1st July 2000 had been sold by Organ Limited. So the inventory has been sold. The machinery was expected to provide future benefits evenly over the next 2 years, then scrap, right? So the machinery, this fair value, we need to depreciate over next 2 years, over next 2 years. But remember, since when they prepare accounts, the depreciation is based on this. What we have to do is only to provide the additional depreciation based on the difference of rupees or the dollars 20,000. Then, of course, 2016 Organ Limited furniture upwards. Again, there is a upward of furniture, that is, increasing the value, that is bringing the fair value, and revaluation surplus of 4,200. So thereby, when you increase the furniture by this much, the revaluation surplus will be increased by 4,200. Now financial state normally 3-year period, and now this is the idea. That's why here it says multiple years. Multiple years means now we acquire this business not on 30th June 2014 really. We acquire this business really first. We acquire this business 1st July. Can you remember? 1st July 2013. 1st July 2013 we acquire. So thereby this is the first year financial statement. This is the second year financial, that means profit and loss. This is the third year financial statement. So thereby if we are here, we have acquired this business about 3 years ago. That's the idea. We have acquired the business about 3 years ago, not now. So that is the meaning of multiple years. This is the meaning of multiple years. Is it clear? And prepare the entries in the consolidated worksheet of FIC Law Limited. Apply the equity method to its investment of Organ Limited for each 3 years ending 30th June 2014, 15, 16. Now the question is clear. We have to put the double entry in the books of investor, not for 1 year, but for these 3 years. That is the idea. Now, I think you can remember, again, there are 2-3 crucial informations. The acquisition percentage is given, consideration is given, and net assets as at acquisition is given, but we have to increase this net assets for the fair value adjustment as at this date. Now you continue the business. When you continue the business, so it says that inventory which was in for 70,000 being sold on this date. That is another important information. And other information issue is the what they call the machineries next 2 years only depreciation. Next 2 years, that means 50%, 50%, and tax rate is 30%. And also dividend declared June are paid within 3 months and liabilities being raised at the date of declaration. And here the further information, furniture is you are upgrading or upwards revaluations, and thereby result revaluation surplus is 4,200. So with this, look at this profit and loss. You get the profit here, profit here, profit here, and you have to remember this is the results of for the period, results for the period, profit and retained earnings. That is the opening retained earnings, opening retaining earning, which was here. This 80,000 is here, and this 98,000 closing retain here. You can remember here closing retain here. Okay. So this is the profit total retain 1 year later, retain profit 2 year later, retain profit 3 year later. You have to understand this. First year, 1 year later retain profit, the cumulative. Second year later cumulative retain earnings, third year. Then dividend is not expense if you deduct it from the equity statement. So thereby dividend paid and dividend declared altogether here they have given, so that is being deducted. And also transfer to general reserve. Transferring general reserve is not affecting to the equity method, because it's just mere transferring a particular amount from one reserve to other reserve. So thereby there won't be change in the equity. Just you are changing the figures of two respective reserves. You are not increasing the equity, you are not decreasing the equity, just transfer. So thereby there is no impact when you account for equity if there is any transfer between the reserves. So coming back to the question, prepare the entries consolidation. So what I am asking is, can you calculate the goodwill of this question? Goodwill. So goodwill is very simple. Investment you can take 122,400. Answer is with me. So we will see the answer, because it's easy for me to discuss the answer on the on these sheets rather than writing. Now you can remember the cost of investment is here, right? And you can remember these 200,080, that is the book value of equity given in the question at the acquisition date. And you can remember this 20,000 and 10,000, this is the machinery upward and this is the inventory upward. That means the fair value increase. So 1 minus 30 is the tax percentage. So thereby total equity of this question is 301 and you take 40%. When you take 40%, 120,400 is the the value of the net assets acquired by the investor. How do you say? This is the value of the net assets as at acquisition date. At the acquisition date, net assets at fair value, and you take 40% of this. So this 120,400 is the fair value of the net assets acquired. And for that acquisition, you paid 102,400, 122,400. So thereby, you see, you are paying more than what is being acquired at fair value, which is 2,000. So you consider this 2,000 as goodwill. That is the first calculation. But we are not really putting the goodwill in the balance sheet of the investor. This is just to understand how goodwill they are inside this purchase consideration. In this cost of investment, goodwill is there. So goodwill is the difference between these two figures. And also, now when you are brought in these two adjustment into the books, how do you put? You bring the assets into the books. So thereby, when you bring those two, what happen is you need to provide additional depreciation in the books of the investor when preparing consolidated financial statement. You have to remember, when preparing consolidated financial statement, and also this 10,000 when preparing consolidated 5,000. So thereby, now you see the 20,001 minus 30, that is the net of tax, and you take 50%. Why you take 50%? Because 2 years depreciation. 2 years depreciation means you divide it by 2. That means 50%. So here 7,000, and here the tax, net of tax story for the inventory is 7,000. What I want to communicate to is that for this 40,000 profit which is recorded by the investee, that is organ, has to be adjusted for these two entries. So you will see here 40,000 is taken and inventory 7,000 and depreciation 7,000 minus. So thereby what happened is your 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 profit for the period is 26,000. From that you take 40%. Out of this 26,000 you take 40%. Is it clear? Is it clear? Now you have to remember at this acquisition point, this increase 10,000 is the closing inventory. You consider it as closing inventory. So you have prepared the financial statement based on 60 as the opening. You know, always closing inventory will become the opening. So thereby what happened is you have calculated this profit for 60,000, and what is required now is you have to calculate the profit based on 70,000. But you have to remember, since we use the equity method, we have to only take the investor's portion. 60,000, 70,000 difference is 10,000. From 10,000, you take only the net of tax 40%. So that's why here we take 7,000. Deduct. That's why we are deducting adjustment for the opening stock here. Is it clear? Right. So this 10,000 is the share of profit for the first year. How do you record it? You debit the investment in associate joint venture, that is 10,400, and you credit the share of profit on loss associate joint venture 10,400 in the investors books. And of course dividend revenue you put as, you know, income, dividend revenue as income, and investment in associate 4,800, you know, as you are reducing it from the investors books. Basically what I want to communicate to here is, so you see the dividends 5,000 paid and 7,000 declared, so thereby it's altogether 12,000. From 12,000, when you calculate the 40,000, of course you get the 4,800. When you prepare the consolidated financial statement in the investors books, you take dividend revenue. You debit the dividend revenue and you credit the investment. Is it clear? Debit dividend revenue account and credit the investment account. Okay. So thereby net assets, net increase is basically 10,400 minus 4,800. That is the 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 story. Is Is it clear? Okay. So how do you show it in the books of the investors consolidate financial statement, which will be like this. You take when you prepare the consolidated financial statement of say investor, investor is I think PPLC කියලා කියමු. PPLC. So if you prepare the financial position, I hope that you can see the Excel sheet also. Financial position. Okay. You have to remember we prepare this is for the period as at 30th June 2000 when 30th 6th 2014 I think. Yes, that is the period. So I take this part separately because okay, right. Then the balance sheet information, this is balance sheet information. So you may have different assets of the investor. In that you get the investment in associate, investment in associate, investment in associate. Can you remember the word? And joint venture. Here what you have to do is you have to put two things. One is what you call the initial investment. I think you can remember, and now we are increasing it by 10,400. 10,400 and also minus 4,800 because that is the dividend portion. And can you remember the initial investment of the business? Initial investment, can you remember? That was 122,400. 122,400. So those are the figures we put journal entries and that is the, so the total value would be how much? Total value would be the 117.600. Is it? Cost of investment 122,400, then 10,400 and 4,800. Okay, that is the investment in associate asset. What do you call? But when you prepare the financial statement, sorry, the profit and loss, share of profit in associates, share of profit associate would be 10,000, 10,400. That is the share of profit. And also you see we are debiting dividend revenue item. So dividend revenue, this is a credit item and dividend revenue. So you can put 4,800 minus figure. That is the, these are profit and loss figures. These are, I would say, balance sheet items. So shall we go to the next one? Then next one is consolidation worksheet 30th June 2015. So what I will do is, for you to understand, first of all, I will focus on uh, the, the profit of the business. Can you remember here the profit is 60,000? Profit is 60,000. Is it clear? So I will skip this calculation. This is I will come back to this one later on. I will focus on this one. Can you remember the 60,000 second year profit? And can you remember this 7,000? That is the second year depreciation. So you adjust second year depreciation. So the adjusted profit 53,000 and profit is so much. The portion of profit is 40%. And how do you put the double entry? Investment in associate joint venture debit, share of the investor is credit, and you see the dividend in the second year also. So you take 40% out of this 10,000, 15,000. So 40% is really 10,000. You debit the dividend revenue and credit the what do you call 10,000. Is it clear? So if that is the case, how do you put the third next year this thing? So I will take the Excel sheet again. I hope you can see it. Here, what happened here? You can remember the next year is 30th June 2015. They are preparing 15 financial statement now. Okay, so you can remember the figures. Share of profit is 21,200. Share of profit is so much. Can you remember how you took it? Yes. Then the dividend is 10,000. Dividend is 10,000. So what happened? So you start with 122,400. 400. And you have to put the same entry plus these two. 10,400 minus 4,800. Again 21,200 and minus 10,000 store. So altogether, your balance would be, investment account would be 139,200. Now, how do you reconcile? Now I just wanted to tell you. Now you start from the costs under equity method. You take the share of profit in the first year and you deduct the dividend portion. You get the equity method cost, value of the equity method. In the second year, you know, about 1 year, 2 years back, you invested this much, and the first year share of profit is so much, first year dividend is so much, second year share of profit is so much, second year dividend is so much. So thereby cumulative value under equity method is 139,200. Is it clear? Now what I want to do is, I do want to discuss with you the, the other calculation which was in the chapter. So I'm just putting you the attention onto this page. So we are discussing 30th June 2015, and what I did was I discussed this calculation with you, these two calculation, but now I just put your attention to something else. Now look at this one, movement in retained earnings since acquisition date. Can you remember at the acquisition date it was 80,000. At the acquisition date your retained earning was 80,000, and 1 year later your retained earning was 98,000. Can you remember? Again, if you go back to the question, if you have the question, you can see your initial equity retained earning was this much. Your year end, first year end equity is so much. So thereby, what is the difference? Difference is 18,000. And you know that there is a movement in general reserve. You have to add it back. So you have to add the general reserve transfer. As I told you, there is no movement. So you just add it, because in the retained earning, this has already deducted, but you have to add it just to get it back. Okay, retained earning you have to add. And you can remember we made two adjustments in the first year. We made these two adjustments. So you deduct it. Basically, the investor's share is 5,600. How do you take investor's shares? 40% into, 14,000 into 40%. 5,600 is the journal entry, investment in associate joint venture debit, 5,600, and retained earnings increased by 5,600. That is the story. Is it clear? Okay. Plus this. So thereby, again, coming back to this one, you will see. I'm just sharing the Excel sheet, but little difficult to understand. You have to understand what I'm telling very clearly. Now again, I am asking you to just focus on these two figures. So you know these two figures is 5,600 definitely. So thereby what we do is we put instead of putting yearly adjustment, we call this adjustment for retained earnings. So adjustment for retained earning is 5,600. So thereby instead of these two figures, what we do is we put 5,600. We put 5,600. Is it clear? If I'm doing it in a different manner, what I will do is I will just show you the same thing. So retained earning adjustment, RE adjustment. Here RE adjustment is not there because it's in the first year. That adjustment is not there because it is in the first year. That adjustment is not there because it's in the first year here. And here the same adjustment, I will take it here. Okay. So you get the adjustment. Shall we come back to the 30th 6th 2016? Yes. We start with same figure, 122,400. If multiple years, we have to calculate what is this balance. We have to calculate this. We don't know. We have to calculate this, and we have to calculate this. Is it? So you have to remember, this is the retained earning calculation. This is the share of profit. This is the dividend. Shall you go back to our question and see how third year calculation is taken place? Here, consolidate worksheet 30th June 2016. Just look at, now we are taking the retaining earning for 2 years, not for 1 year. You can remember 80,000. You can remember 80,000, that is the acquisition date, retained earnings. And 123,000 is this. That means that is the second year retained earning, up to the second year. Without this 70,000. If I am telling you this 123,000 means this, and this, and make the adjustments, relevant adjustments. Anyway, so you take the opening retained earnings, as I told you, the difference. So difference is very clear. No need of taking more time. 120,000, 80,000, that is 43,000. Is it clear? And you can remember movement in general reserve here 20,000. Why it is 20,000? Because it is 2 years. 10,000 here and 10,000 here. That is 20,000. So you take the 20,000, right? Movements in general reserve. And you can remember, since we are talking about cumulative, we are talking about cumulative. Retained earning means cumulative. 20,000, and here not the 7,000 2 times. Why? We have already taken 2 years story, 2 years cumulative retain. So thereby 14,000, and you can remember the first year inventory story, and you are deducting 20,000, and your profit, adjusted profit is 42,000. You take 40%, that is 16,800. And also you have to make the dividend adjustment. Look at the dividend in the question only. Yes, dividend is 15, 20,000, 15 and 20,000. That is there. Anyway, that is 20,000, and we took what do you call 7,000 and 16,000, and so the retained earning adjustment is 16,800, 16,800. But dividend adjustment is not here. I'm sorry, you are not making any dividend adjustment here. You take 16,000 investment in share and 16,800, and you take next working as you take 70,000. That is the third year profit. You make the machine depreciation, pre-acquisition, machine depreciation. I'm sorry, here. Depreciation of machine, and here investors 25,000, and other comprehensive 42,000, Investors share of profit 1,000, this amount. So when you go back to this adjustment, you have to understand why we make these two adjustments. You look at by the inventory on hand 1st July 2000 had been sold and maturing was expected to provide future benefits evenly over the next 2 years. Then the scrap the next 30 here. In January 2016, Organ Limited revalued furniture upward by 6,000, affecting the assets revaluation surplus of 4,200. So thereby you have to bring that amount, that entry to the books. That entry to the books. Here, other comprehensive income investee 6,000, 1.1 minus 30%, that is tax story, and 4,200. So altogether, from that you take 40% here, and from this 63,000 you take 40%. Okay. So you put the journal entry, investment in joint venture debit and share of profit credit, investment in a joint venture debit, share of comprehensive income credit, and again share of other comprehensive income in associate joint venture debit and asset revaluation credit. Now what I want to communicate to you is that if you look at these four journal entries, you will see investment in joint venture, this and this. Now if you look at these two entries, this entry and this entry is what I call setting off share of other comprehensive income in credit here. In the second journal entry, same account debited. So thereby finally what happened is this and this contra, and finally what happened is this entry and this entry. That means investment in joint venture account debit and assets revaluation surplus account credit. So dividend revenue 14,000. So if I am going again, going back to my normal calculation, you can remember my calculation, Excel sheet, and what would be the figure here? So figure retained earning adjustment there, of course, can you remember 16,800. 16,800. Is it clear? Okay. And here the adjustment is, you see, 25,200. Retail profit for the period 25,000. $25,200. 25,200, which is the share of profit. Here it is dividend, that is the portion of dividend 14,000. Here it is 14,000. Can you remember? 40%. And you have to remember there we have to put a extra entry which is OCR. This is really the return profit for the year. This is profit, share of profit. I would say share of profit. Share of profit. This is the dividend adjustment. Dividend adjustment, and this is OCI story. Anything was coming to the OCI, you have to put here. Here OCI story is I think 1650, 680, 1680 OCI, right? In addition to these entries in this year, in your balance sheet, you have to show revaluation surplus. Revaluation surplus of 4,200, no? If you are putting in the journal entry in the, you have put the journal entry, and what I'm telling is the balance sheet items, the extraction of balance sheets I'm just showing you. So thereby here the balance would be, the amount would be, you know, this, here it has to be minus, no? $14,000 minus. So here the balance has to be, yeah, 110. And the profit would be, how much the profit? 25,200. Dividend, of course, 14,000 minus figure. And OCI, separate OCI item, there should be OCI item. In the OCI, revaluation surplus has to be 1,680. Okay, so that is the journal, that is the adjustment, that is the what do you call balance sheet extraction. These are balance sheet extraction, and this is really the what do you call profit and loss and the OCI state. But we are not showing all these items in the balance sheet. What we do is basically we show only these two items in the balance sheet. No? On the page of the balance sheet, we are just showing these items. We don't show these what is in red is not presented in the on the page of the balance sheet. We don't show these entries in the balance sheet. Only we show these C's. So investment in associate so much, realization surplus, share of profit, dividend, and because here dividend revenue, not the income, OCI. That's all. So I think with that, that question is over. So what I'm asking is you have to practice this the multiple year. You have to understand why we are putting the movement of earnings and the respective year adjustment. Right. Then we will talk about dividend reserve, dissimilar accounting policies, and different ends of reporting periods. What I want to uh, where no consolidated financial statements are prepared for, I'm talking about now dividend paid and payables by joint venture and the associate, this part, where no consolidated financial statements are prepared, the entry investors recorded, that remember this is very clearly, where no consolidated financial statement, that means individual investors financial statement only, not the consolidated. Then of course journal entry for dividend is this, you have to remember very clearly, cash account debit, investment in associate, joint venture credit. But when you prepare consolidate financial statements. When you say consolidate, there is no such entity. When you think about no consolidate financial statement, means you are preparing the financial statement for the investor. Investor is there. In this case, investor is, I think I remember the investor is P. Can you remember the name of the company, investor here? Who is the investor? Piclo. Piclo Limited is the investor. Piclo Limited is the investor, right? And Piclo Limited is the investor. I'm sorry, I think I made a mistake. Yeah, I was. Yes, 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 yes. I did a mistake. Huh. Yeah, no? Dividend. So you talk about here dividend reserve, dissimilar accounting policies and different end of reporting period. We talk about dividends here, reserves, dissimilar accounting policies and different end of reporting period. First of all, we'll talk about the dividend. We are talking about the dividend. When you talk about the dividend, in the consolidated financial state, if not prepared consolidated financial statement, dividend journal would be cash debit, investment in associate joint venture credit. But when you prepare consolidated financial statement, the journal entry, not the dividend cash, it has to be dividend revenue. Dividend revenue debit, investment in associate joint venture, investment asset account will increase by that. So if you read this here, you can understand all dividends paid or payable by an associate or a joint venture to an investor are recognized as revenue in the profit and loss of the investor. You have to understand very clear. All dividends paid and payable joint venture to an investor are recognized as revenue in the profit and loss of the investor. In relation to the dividend, there is no need to classify the equity of the associate joint venture into the acquisition and post-acquisition equity. So, like consolidations, financial statements, we don't divide the dividend into, pre-acquisition dividend and post-acquisition dividend. We don't do that. Effectively, all dividends are accounted for as if they were paid or payable from the post-acquisition equity. So whatever the dividends, we consider it as paid out of post-acquisition equity. You know the meaning of post-acquisition equity. When the associate and joint venture declares a dividend, the investor records dividend revenue. As noted earlier in this chapter, because the investment account has been adjusted for the investor's share, called all action equity, applying the equity method requires an investment account to be adjusted for dividend paid or declared. So that is that. Now, when you have the preference shares, the share of profit calculation after payments of dividend, you have to remember. You have to deduct the dividend for the preference shares. That's the idea. 100, 20. So based on this 8, you calculate the your profit share. Remember, when there is dividend, preference shares dividend, you have to deduct it from the profit of the associates. Right. Reserve. The equity of the investee may also increase, decrease via changes in reserve balances in the associate and joint venture. There are 3 situations to consider. 3 situations where post-acquisition reserves are created by amounts taken directly to equity. An example of this is where associate joint venture recognize an increase in the assets revaluation surplus. When there is an asset revaluation surplus, what we have to do is you increase the investment in associate by debiting and you charge other comprehensive income, OCI, you credit OCI, that is just to disclose in the other comprehensive income, you put this entry. But you have to remember, really it has to be reflected in the revaluation reserve. So thereby what you can do is just to bring that item value to the revaluation reserve, you just put another entry, share of other comprehensive income, you debit same amount and credit the revaluation. What I want to communicate to you is that by putting these two entries, you put a contra entry. Real journal entries, investment in associate and joint venture, and credit the assets revaluation. So these two entries are just to make items in the OCR. Okay. Where reserves are created by associate by reflect pre-acquisition equity. This is post-acquisition. This is pre-acquisition equity increase. So that you will consider when calculating the cost of investment. Here, reserves on hand at acquisition date may be transferred to other equity accounts after that date, as these amounts are recognized in investor's cost of investment, and thus the carried amount of the investment in associate. No further adjustment is necessary on application of the equity method or movements in pre-acquisition equity. So pre-acquisition equity, when you invest in a business, all these pre-acquisition equity increase, decrease considered, so thereby it will reflect in the investor's cost of investment, so thereby no entry is required with regard. You forget about this second category. Where the associate create reserve by transferring amount from retained earnings, that means from retained earning to general reserve. You just transfer. No need to adjust the general reserve in increase of assets. So thereby you are making entries only for the first category, where post-acquisition reserves are created by amount taken directly to the equity. So under this method only, we put double entries. Under these two methods, with no entry. What are the no entry? Pre-acquisition equity increase and also transfer to the reserves. Dissimilar accounting policies, of course, if there are dissimilar accounting policies, you have to convert. If you prepare the consolidated financial statement, convert associate financial statement into the investors. Different period, of course, you have to make necessary adjustments for the period to match. Then investing in associates in stages. Now, again, you have to remember very clearly this. What shall we do? We will, yes, we will do this and finish it off. We'll finish it off from this. Investing in an associate stages. You know the meaning of associates. You may have 5% intake interest, so you increase by 10 and again another 5, 15, another 20. Likewise, step by step you get the significant control. So thereby at this situation, what you will do, we'll take one example, then you can understand. I hope that you can understand what is the meaning of stages. In the first stage, you don't have the significant influence. You acquire more shares, then you get the significant influence. Then how to account for? Assume C Limited acquired 10% of shares H 1st January 2015 for 13,000. What do you mean by that? 10%. So thereby it's less than 20%. No significant influence. At 31st December, entities reporting period, the fair value of the investment was 16,200. You have to understand this. This amount, right? this particular amount, the January, this date, has become 16,200 under this, at this date. Gain or losses on financial instruments are recognized and profit or loss. This is the financial assets through profit and loss. So thereby fair value change, the differences in fair value, you charge to the P&L. 13,000, 16,200, the difference is you charge to the P&L. Okay. On 1st July 2016, that is 1 year later, හරියටම මෙදාට දවසකට පස්සේ 1 year later of this investment, C Limited acquired a further 10%. This 10% plus this 10%. Now we assume that C will get the significant influence from this date onwards. C will get the influence, significant influence on this onward. So 20% is the equity. Now investment in equity is 20%, but this was taken step by step. This was taken by step by step. But what is the step? First step, first 2015. That is the first step. What is the second step? 1, 1, 1 again 2016, not the 15. 10% and another 10%. Altogether 20%. Okay. When the equity holdings limited consisted, now by that time your investment, what do you call this, net assets, share capital, asset revaluation surplus, retained earnings, profit. Profit is really, you know, I'm sorry, this is you acquire 10%, not July, not the one. July. That means 1.5 years later, not 1 year later. 1.5 years later, you acquire this 10%. So thereby, at the acquisition date, the equity is given plus 8,000 for the next 6 months. After 6 months, first year, right? Identifiable assets and liabilities were recorded at fair value, and at the date of extract, inventory whose fair value was 15,000 greater than the carrying amount. Acquisition gives significant influence over whole. So at this, in addition to this, what we have to do is the 15,000 carried amount you have to brought in to the equity, right? So what we do is C Limited would record its investment in Horn Limited at 13,000 at this date, because that is the fair value here at this date. But as at 31st December 2016, C Limited will invest 16,200. The difference will be charged to the profit and loss, as I told you earlier. What would be the at 1st July 2016 when C acquired another 10%? 1st July, because you acquired the on this data 1st July, so you consider it as an associate. Becomes an associate in accounting for its previous held investment. Horn Limited will remeasure its investment to the fair value. So now what we have to do is, now if I am telling you this investment, now I think you can remember the dates here. The first 2015, agree? That is 13,000. One year later, that is I would say 31st December 2015. 1 year later, this is of course 16,000. How much? 16,200. Meda 16,200. Now you acquire another 10%. Mename 1/7 2016. Are you clear what I'm telling? Here 6 months. Here period is 6 months. Here period is 1 year. And you know the investment value at this date. And you know the investment value at this date. What this particular standard says, if you consider this investment as financial assets, you have to bring the fair value as at this date. Fair value. That is the story. That's what I'm telling you. You bring the fair value. Here, C Limited will remeasure its investment to fair value, record any change in profit and loss. Change in if there is now here you can remember this change you charge the P&L. Here you take the fair value of this investment and change you charge to the T&A. Okay, I think that's clear with regard to this case. Just look at the double entry. Investment in bonds 1,000, remeasure of investment 1,000. Now you will see in somewhere else it says that here. So you acquire 17,200, another 10%. That means same shares, the previous 10% also fair value is same amount. We have to remember in the question 17,200 is given for the second acquisition 10%. The same share you are purchasing. Previously you have purchased 10%, so thereby we assume that the fair value as at this date of the previous investment is 17,200. So thereby 16,200, 17,200 difference is 1,000. Investment in home debit and the income account, profit and loss account credit 10,000. The difference here, any change, that is the change 1,000 profit and loss. The previous sale is now recorded by the investor at fair value and blah, blah, blah. So investment in Horn Limited 17,200, cash 17,200. This entry is for the new investment 10,000. This entry just to bring the previous investment to the fair value. This entry to record the new investment in the books. That's why we are crediting the cash. Here, acquisition further shares in Horn Limited. Here, remeasurements of investment becoming an associate. So you will understand the narration. So you can calculate the goodwill. Simple. How do you calculate the goodwill? You take all these. No? You take all these plus the increase in inventory. 1 minus T, that is tax. You take 20%. So 20% is so much. Investment is 17,200 2 times because 10%, 10%, 2, 10% story. So the goodwill is 7,000. So thereby, how do you record? How do you do the investment in share of profit? Now I think you can remember the profit for the period is 8,000, given 8,000 for the 6 months. If Fond then recorded a profit of 20,000 for second half of the second half of the period at December, so would recognize 20% share of that amount of so thereby 20% of this would be 2,300 and 2,300. Then recorded profit of for the second 2000 at December, the would recognize 20% share of the adjusted after tax profit. So you just take it 1 minus 30 here, 22,000, 15,000. Again, you have to remember very clearly this 15,000, which is closing stock, will become the opening stock of the next period. So thereby, this 15,000 opening stock, you have to deduct from the profit and 1 minus T and 20%, that is investment in associates and share of profit associate 2030. Is it clear? So how do you record this? If you want to just record this in the period of 6 month ending 31st 12 2000, I would say, I think 16 31st yes 16. This is for the 6 month, 6 month, not for 1 year. 6 month consolidations. Investment in associates, you know the figure, investment in associates, I think you can remember 17,200 double 17,200 and 17,200. Hey, 10% ඒවා දෙකක් නේ නේද? එතකොට 34,400. Can you remember? Plus the share of profit for the period is share of the profit is 2,300. 2,300. So that is your value of the investment in the financial statement. That is the value. Balance sheet, you show this one. Which figure you show? Really, you show this figure. On the face of the balance sheet, you are showing this one. You don't show these workings, huh? Yeah, workings. You don't see, we are not presenting on the face of, this is the final figure. And the income statement, you say share of profit, which is 2,300. That is for the 6 months. That's all. එතකොට අපි අපේ මේකේ දාන්නේ 36700යි නේද? 2300 විතර. Okay. I hope you understood this very this one is little bit complicated, but please study the chapter. I have already uploaded that chapter to the someone told me that it's not available. I think it's there. Chapter is there. Just tell me whether chapter is available in the LMS. Is it available? LMS? I think chapter is available. I have uploaded the chapter. Okay. Thank you very much for joining. And tomorrow also we will have 1 hour at least. We will meet at 3 o'clock and we will have 1 hour. Then we will be able to finish this chapter. We have next week also additional lecture. Additional means the dean has extended the academic calendar by 1 week. So we will meet next week also. Tomorrow we will have another 1 hour session. Okay. If you have any question, you can put. Otherwise, I will end the meeting. Please read the chapter very well. I know that this is a little bit difficult to explain in online. If you have followed the material, just easy. If you have don't follow up the material, just come for the lecture. Very difficult to follow, not like in physical class. Okay. Thank you very much.